For any parent, it's a big undertaking to save for a child's education. One common method to achieve this goal is through Registered Education Savings Plan, also known as RESP. RESP is an investment account that can receive government grants based on contribution and net family income. Some provinces, such as Saskatchewan and British Columbia, may offer additional grants. RESP accounts enjoy tax-deferred status, meaning that any investment in this account enjoys tax-free growth until the funds are withdrawn. But before we dive in deeper, we need to go over a few important details. RESP accounts can stay open for 31 years, allowing for children to pursue academic studies and career changes with flexibility. However, unlike RRSP, RESP contributions are not tax deductible. The person who opens the RESP account and makes the contribution is called the subscriber. Accounts with two subscribers are called the joint accounts. Joint subscribers must be spouses as defined by Income Tax Act. There's no limit on how many RESP accounts that a person can open. Furthermore, the subscriber is always the owner of an account, not the beneficiary. The child named in the RESP account will be the beneficiary and is eligible to receive money from the RESP account if used for educational purposes. There is also no limit to the number of RESP accounts that list the same child as beneficiary. An example would be a child's parents opening one joint account and 4 grandparents each open an individual account for the same child. In this case, 5 separate RESP accounts all list the same child as the beneficiary. There's very little difference between individual plan versus family plan because funds can be transferred to siblings' accounts. RESP has a lifetime contribution limit of $50,000 per beneficiary. This includes all contributions made in all RESP accounts. There are 3 types of grants that a child could potentially receive. The first one is called Canada Education Savings Grant, also known as CESG. All children are eligible to receive this grant. The federal government will match 20% of your contribution, up to $500 per year per child, until the year child turns 17. If you do not make a contribution in any given year, the grant loan carries over into future years. Additional Canada Education Savings Grant applies to middle and lower income families. The government will match additional 10 to 20% on the first $500 contributed based on net family income. Therefore, you may receive additional $50 or $100 in grant every year. The third grant is called Canada Learning Bond. This grant only applies to low-income families. The government will contribute $500 for first year, then $100 each year, up to $2,000 in total. This grant has no contribution requirement. Lifetime grant limit is $7,200 per child. This amount includes all the grants listed above. I know these numbers sound quite confusing, so let's pull some information from Canadian government website and run a couple of scenarios. When you look at the tables, you'll notice that RESP recipients are broken down into 2 groups, up to 2006 and 2007 or later. Since it's already year 2021, we will focus on children born in 2007 or later. We will assume your net family income is $100,000 and your child was born in December 2019. Because RESP eligibility is solely based on calendar year, you would have accumulated 3 years of CESG room for a total of $1,500. You will not receive any additional grants due to high income. One way to do it is to make $5,000 contribution this year and next year to receive $1,000 in grant on both years. This is because the maximum amount of CESG a child can receive each year is $1,000, as shown in the table. Going forward, you will contribute $2,500 each year to receive $500 in grant. Because the lifetime grant limit is $7,200 per child, you will need to make a total contribution of $36,000 to max out the government contribution. Another approach is to contribute $50,000 in one go and receive $1,000 in grant this year. Since you have met the $50,000 contribution limit, you would not be able to make any additional contribution, therefore will not receive any additional government grants. This is a viable option for families with huge cash reserve because many years of compounding will outperform annual contribution of $3,000. Now we go back to the same example, but your net family income is $45,000 a year instead. In this case, you qualify for 20% basic CESG and 20% additional CESG. Because you have to support your family, so you're only able to contribute about $42 a month for a total of $500 a year. This will net you $200 in government match, $100 from the basic CESG and another $100 from the additional CESG. That's a whopping 40% of your contribution. Therefore, if you're able to continue making $500 contribution every year until your child turns 17, you will have contributed $7,400 and received $3,000 in match from the government. Now, because you are classified as a lower income family, the third grant called the Canada Learning Bond will kick in as well. This grant will pay out $500 for your child for the first year of eligibility and additional $100 each year until your child turns 15 for a total of $2,000. So in this example, contribution of $7,500 actually gets you a $5,000 in government match. So what if your family income is low and have absolutely no money for RESP? Well, still open RESP for your child because CLB does not require any contribution. Therefore, your child can still get up to $2,000 in CLB as long as you open an account early enough. One of the biggest fear or confusion many parents may have is what happens to the RESP account when their child decides school was not for him or her. For demonstration purpose, let's assume your total contribution is $10,000 and you receive $2,000 in grants over the years. After years of compounding, the money in the account is now $25,000. Because your child does not wish to pursue school, you decide to collapse this account. The funds inside the account will then be divided into three components: amount contributed by you, grant received, and accumulated income. In this case, the contributed amount is $10,000. This amount will be returned to you in full, tax-free. The $2,000 in grant received must also be returned to the government. The remaining $13,000 falls under the accumulated income and is taxed at your marginal tax rate plus 20%. So assuming your marginal tax rate is 30%, this $13,000 will then be taxed at 50%. Therefore, you only receive $6,500 in cash. However, this tax penalty of 20% can be entirely avoided if you transfer $13,000 accumulated income to your RRSP account. And do not worry about CRA coming after you, because this is actually recommended on the government website. So what's the key takeaway? There are really no downsides to RESP. Make sure you take advantage of the government grant and invest appropriately for your child.